Okay, for today's hybrid seminar, we'll be sharing on ABSD measures, impact on property wealth succession. We have invited established speakers, Mr. Chiwi and Mr. Yong. Our first speaker, Mr. Yong, is the CEO and Key Executive Officer of International Property Advisor Private Limited. Prior to running his own practice, Mr. Koo was the director in the private banking sector, responsible for advising clients on real estate investments. He's one of the very few property agents who have been appointed as adjunct faculty in SMU, NUS, and Niam Polytechnic. As an expert in the real estate field, Mr. Koo has written many books on real estate trends and investments. And our next speaker, Mr. Chiwi, he is the CEO of Precepts Group International. He is widely recognized for his expertise in trust industry. Mr. Lee is a TEP member of Society of Trust and Estate Practitioners. He has been an adjunct lecturer at SMU Master's Program in Wealth Management for Estate Planning and Tax. Mr. Lee has also authored various estate planning books such as Precepts Group Succession and Trust in Wealth Management, which is a book that is widely acclaimed in the financial services industry as a leading guide in estate planning. So today we are honored to have both Mr. Lee and Mr. Koo here to join us and share some of their insights on how property market trends and ABSD measures can impact property succession, wealth succession. So before I invite our speakers, I would like to share with you our program schedule for today. We will start off with the sharing by Mr. Lee and Mr. Koo. Subsequently, at 3 p.m., we'll have a 10 minutes break and we'll resume at about 3:10. So about 3:10 till 3:45, both our speakers will continue their sharing. At about 3:45, we will have a Q&A segment. So for those of you who are here physically with us, if you have any questions at that point of time, you can raise your hands and then I'll pass on the mic to you guys. You can ask your questions and our speakers will answer. For those of you who are joining us via Zoom, we have a Q&A feature for the Zoom itself. So please do type your questions onto the Q&A segment and our speakers will look through the questions and answer accordingly as well. So I hope today's session will be an enriching experience for all of you. I'll hand the time over to the speakers.
Thank you, Lisa. And a good afternoon to everyone, whether you are in Singapore, Malaysia, Indonesia, or Hong Kong. I think these are the few places where we have some of the virtual participants. So how am I going to do today's session would be a little bit of a discussion. We can call it also a dialogue with Swee Yong. And we're going to look at some of the market trends as well and see how it's going to impact on the manner in which your clients who own real estate in Singapore, focusing primarily on residential properties, would need to really engage in serious estate planning, because if they get it wrong, the impact could be quite devastating, right? Okay, so let me pull out the slides. Okay, how do I turn it on? Sorry for that hiccup. Press here, right? Oh, technical hitches. Just give us a moment. Right. Oh, well, okay. A disclaimer. As we speak, certainly you can understand that changes could just come in very quickly, like what the Singapore government has done in the stamp duty changes regime. All right. So some of the things that we're going to explore would be focusing on inheritance of real estate. How can the planning be a bit better? And of course, the planning would be impacted by and shaped by the regime, right? We're not just going to be talking about stamp duties. And another very important tax is property taxes. I think that's going to be perhaps even of greater impact as we go into those clients who have retired but living in multi-million properties, and they find that living in their own homes
Getting expensive.
will be very expensive. Yeah.
Yeah.
All right. And because of the foreigners, especially who already own homes in Singapore, I think there is a dire need for them to understand the consequences, how stamp duties, ABSD will pan out when they deal with inheritance. Okay, so this was the announcement, and I'm going to flash some of the headlines in the media following what was announced in April. So one of the very glaring headlines is that if you are, marketing properties to foreigners, how are you going to tell them, oh, sorry, you just missed the boat. You failed to sign the option. What was the cutoff date? 27 of April. Suddenly you have to pay a lot more stamp duties. It's doubled to 60% for foreigners who wish to buy residential property in Singapore.
But we property agents have a way of getting around this little hurdle. We tell the foreign buyer, please quickly sign now. Otherwise, it may go up to 100% or 120%. So better buy now. Quick, buy another one, in fact.
Okay, well, other than the foreigners, perhaps even for the Singapore citizens. So let me just show you the impact of the changes. There's no change if you're a Singaporean citizen buying your first property. It remains at 3 to 6%, depending on the value of the property. But if you're going to buy your second residential property, that rate was already a deterrent at 70%, but now it's been bumped up to 20%. If you're buying your third and subsequent residential property in Singapore, that rate is now bumped up by another 5 percentage points to 30%. If you're a permanent resident, a newly, someone who has been here for many years and the government has given you that status as a PR, you can buy your first property in Singapore and the rate remains the same at 5% to encourage you to settle in Singapore. And yes, we have to differentiate you from the Singapore citizen. You pay a little bit more than the Singapore citizen. But once you get into second and third property purchase as a permanent resident, the rates have bumped up now to 30% and 35%, respectively. For the foreigners, as we mentioned, it's been doubled from 30% to 60%. And if you're thinking that, well, if I use a company to purchase the residential property, or if I set up a trust to acquire the residential property, well, what's going to happen now? That rate has also been bumped up from 35% to 65%. So it kind of kills a lot of interest for people who think that there are loopholes. The Singapore Inland Revenue is very quick to clamp down on any of these kind of tax loopholes. We'll talk a little bit more on that later, on the inland revenues in a particular kind of so-called loophole, right, later on in the slides. All right, so these are some of the headlines that came out soon after the announcements, right? The headlines say that it's aimed at seizing the runaway private property sector. Madam Ho Ching says, no need to hyperventilate over the latest increases in property stamp duties. As a first-time buyer, you can still, you only need to pay the ordinary buyer stamp duty, but is that really going to be the case when the property prices continue to move up? right? Food for thought. And really, soon after the announcements, it still didn't really had a kind of cooling off. There were some property launches that were moving very well, blossoms by the park for one. And well, point number 2 there says that it sold 205 of its 275 units.
75%.
Yeah, so I think the developers would be really, really happy. If you read the Business Times, it gave a couple of reasons why the property cooling measures may not have actually lowered the new home prices. So I'm just going to flash quickly some of the comments from the market, and one of them talks about pulling back launches, new launches, and point number 2, that's about point number 2. Point number 3, yeah, postponing the new launches. And I guess the big boy developers would know how to tweak with the market sentiment and economics of the day as well. Moving on, and what about the foreigners who are looking to invest in Singapore, right? Would they be looking elsewhere where opportunities are more abound? We could talk about that later. I'll seek your brain on that part in a while. But soon after, you were asked about your insights on these latest round of cooling measures.
This was within the day. So the cooling measure, well, it is a new set of measures. I wouldn't say that it is for cooling the market. It was announced very late at night. If you remember, 11:45 p.m. I was almost going to go to bed. And then after that, the signals started to come in. And then there was already a request, "Cool, can you write me a commentary for tomorrow?" So I've got to submit this by 9 or 11 a.m. the next day. And so I looked through the announcement from the government. Is it really a cooling measure? Because you are increasing the buyer stamp duty, you're increasing ABSD only for that segment of the investment market, which is the foreigners. And already looking at the past 2 years' records, even though we know that property prices have been going up, the actual number of foreigners buying is still less than 10% of any new launch, or even if you included the resale numbers, foreigners buying are actually very small. So by just dealing with the 8% of transactions, making it more expensive for them, doesn't mean that they won't buy. Some may still buy, some may hold back, of course, but it doesn't mean that the other 92% is going to feel the heat at all, and they will probably still be buying. And that's why Blossoms by the Park sold well, and then followed by Far East project at Beauty World sold very well. Most of these are purchased by locals. So if the locals are the ones who are buying at new and higher prices, and that's how the index kept getting pushed up, because new ones are being launched at way higher prices than surrounding older ones, then this set of cooling measures are actually not for cooling. So I can only try to guess what the government's agenda is bringing out this new ABSD. They probably are seeing things that we are not aware of, and they're trying to deal with something else. It is definitely not for cooling. If you want to cool the market, you've got to deal with the locals who are buying at higher and higher prices.
Could the buying also come from the interest of those new Singapore citizens, persons who acquired PRs in Singapore as well?
Yes. So how many of them are new PRs and how many of them are new citizens? Because we have, over the last 2 to 3 years, also heard of a lot of fresh funds coming in under the family office program, under the qualified fund management program, and then a lot of trusts and variable capital company investment structures have been set up for these wealthy people to come, and if they were to put in more than $200 million, they could be express approved, for example, for PRs, and subsequently, if they do invest a lot more into the economy, hiring workers in Singapore, they do become Singaporeans.
Right.
And possibly one person becoming a Singaporean, ultra high net worth, his children also get the Singapore citizenship at the same time. So maybe they'll buy 5 properties without having ABSD. But you can count this number of families, right? And how many they will buy, right? So maybe I give them a total of 2,000 units of purchase in the last 2 years. That wouldn't move the property market index needle, because each year resale transaction plus new sale transactions would be at least about 30,000. And so 2,000 in total wouldn't really move the index needle.
Right.
Yeah.
But I suppose coming out of COVID-19 and how Singapore has fared in this kind of like very well during the lockdowns, I think a lot of other countries had it a lot more worse.
Yeah.
Probably Singapore
We look like a safe harbor.
really attractive for anyone who has been here and continuing to want to remain here.
Yeah.
And looking definitely to take up at least the PR status. Right. Well,
so
question on what's the impact on the rental market with this so-called cooling measures?
In my article, I asked the question of are there steps to deal with cooling the rental market as well, and not from this set of measures. Perhaps from the property tax increase, some owners might decide to stop holding on to vacant units, because vacant units, because of the high property tax now, which we will discuss later, owners now want to rent out and collect back some cash in order to pay the rather hefty taxes. So I have dealt with an owner who is like that. He's retired and he's happily traveling, and he has got 2 or 3 landed houses that he's happy to leave empty, just maintain them. But then now that property taxes have gone up, he has created a net supply increase of 2 houses in the market because of the higher property tax. But
it's also certainly the rental has surged.
Correct.
At least in the last year, I imagine.
Yes, 20% in last year. Yeah.
20%. I thought some cases even more.
Yeah, so that's the
40%.
That's the mean, right? So
right.
When you have the plus minus, yes, some of them have gone up 40%. Yeah.
Maybe a little bit of thought for in the past, we have always been talking about HDB dwellers looking to aspire to now go and purchase their first private residential property. Would they therefore want to, accelerate the purchase?
Yes, so there is some
fear
kiasu FOMO type of behavior where the upgraders might be now pressed to invest earlier in case prices go up some more. But actually, if you sat down and open up a spreadsheet and did your DCF calculations, I find that it's very difficult to justify how stamp duty of, say, 3 to 6% plus the additional buyer stamp duty of another, say, 20%. When you add them on, how much more must your property appreciate over the next 10 years in order first for you to cross the hurdle and break even, and then subsequently make a profit? And plus, we are buying today in a time of very high interest rates relative to the last 15 years. The last time interest rates home loan rates were at 3.5% to 4% was before the Lehman crisis. So homeowners, the Singaporean HDB upgraders do seem to be feeling urgent, especially at the show flats, because we all property agents know how to persuade them that yes, the market is good, get in now. But if you really sat down to do your calculations, maybe you should hold back first and let the froth blow off.
Yeah, so that also then invites some thought as to if you had a penchant for real estate. And the choices are, well, do you want to buy any Singapore residential property at this juncture?
Yep.
Or would you be perhaps looking outside of Singapore for future purchases, for to diversify your portfolio of real estate? Maybe it's been too concentrated in Singapore. You may be looking at diversification. So in the next slide, I have an example of, this was, I found it on the website. One global group, they give an example of your purchase alternatives of buying a Singapore condominium for $1 million, and then you can see it's saddled with stamp duties, issues of total debt servicing ratio, the kind of yields are put there, the estimated rental, etc., compared to a UK condominium, which is at 270,000, really a fraction of what you might be looking to purchase for a condo of 1 million. In fact, a condo of 1 million in Singapore is, you get a very tiny property, I think.
Yeah.
But the UK condo is probably representative, maybe across the whole of the United Kingdom. Maybe slightly exaggerated example, unless you want to get an example of maybe average London property.
Yeah, so this is definitely outskirts of London, pretty far out, not even within zone 6, I would say. But then this example is from more than 2 years ago, because they are still using a mortgage loan rate of 1.6%. Today, our mortgage loan rate is now 3.5% when you buy into a property. So that might wipe out your monthly returns from the rental income if you are geared up to the max. Also, UK has gone up interest rates, but they have gone up to maybe about 5%. So ours is coming really off a very low base, and we have more than double our home loan rates, whereas they are coming off a higher base, so they didn't double.
So let's not talk about the UK, but closer to Singapore, what about Malaysian properties? If your client were looking to invest, ask you, Swee, hey, I got some monies from a IPO windfall, I want to invest in other properties across the region. Let's start with Malaysia.
I have gotten into a bit of trouble for asking people to hold off on Malaysian properties in the past. About 10 to 12 years ago, around 2011 to 13, there was a huge wave of sort of a pandemic of urgency to go and buy into Iskandar properties, and Malaysian properties, in addition to Iskandar, KL, Penang, and then Malacca, property prices actually more than double. In Iskandar, you see 600 ringgit per square foot for freehold, going up to 1,002. In fact, I think the Estaka was launched at 1,700 per square foot ringgit. But today, you look at the numbers, actually, if you haven't gone into Malaysia yet, today, you are buying into Malaysian ringgit property at 3.4 exchange rate. 12 years ago, you would have bought in at 2.5 exchange rate. And 12 years ago, something that cost 1,000 ringgit then at 2.5, today, it may be costing 500 ringgit for that same property that you didn't buy then. And today, you would only be paying based on a 3.4 to the Sing dollar. So actually, for those of us who have got relatives across the causeway, or we don't mind because our jobs can be sort of flexible and coming into Singapore office, then buying across the causeway and telecommuting in or work from home in Johor while collecting a Singapore salary, that's sort of something that might be, but of course, take care of your own personal income tax, because you may become a tax resident in Malaysia instead. But that sort of arrangement might actually be able to help you lower your overall cost and in fact start to save up some money, because the property in Singapore, you can release it and try to earn some rental income back for your own investment as well.
So possibly still attractive if you maybe a retiree, and Malaysia has the Silver Hat program as well.
Yeah, Malaysia, my second home program.
Yeah, that's right.
They have already upped the threshold, but yeah, do find out more about it. The only discomfort I have in recommending Malaysia now is I'm still waiting to see how the politics might stabilize, because they have gone through pretty difficult 7-8 years in the recent past.
Let's talk about your take on Indonesian properties.
Indonesian properties, I've transacted a few with my clients from overseas. We go to Jakarta, we look around, bought some properties. Bringing money into Indonesia and subsequently bringing out your principal and your profits back out, there are a lot of costs involved, and there's proper structuring required. Foreigners are not allowed to own properties directly, especially not freehold. So a lot more homework to do. I would recommend going into Indonesia if you have got relatives there and you JV with your relatives there to buy the properties. Fine. Somebody you trust. If you don't, going in, even getting a trustworthy lawyer and estate agent, yes, set up a nominee scheme, you have to be very careful and do a lot of homework. So overall, not sure if it is worth it. The politics seems to have stabilized quite a lot with Jokowi running, helming the country for 10 years. But then, strangely, international monies haven't really been pouring in, and that's why you can see that the rupiah hasn't been strengthening at all.
Right.
My favorite,
Thailand. Also the political.
Thailand, I keep keeping an eye out for Bangkok. Of course, there are many people who are also interested in Phuket for the luxury resorts and stuff. But that one is more, or considered more as an investment of passion. You really enjoy the environment, you enjoy the facilities, you may invest in some of the apartment hotels or some of the strata titled hotel resorts or the villas in the resorts. That one doesn't really have a price to it. The ROI could be between 1% or 5% a year. Not exactly that attractive. But Bangkok, I thought that big consumer market, big domestic market, in a very young demographic, which would be economically productive for the next 30, 50 years. But unfortunately, again, the last 10 years, the politics hasn't been very nice to Thailand. And so things are sort of now hoping to be stabilized. We have yet to see the installation of the new government, even though they have been voted in already. So let's see how things play out. But if you want to go to Bangkok, again, go there for a week of holiday, spend 3 days looking at properties, look for a neighborhood that you like, and then find a good agent in that neighborhood to bring you around to tour and look at available units that are already built so that you know what is the finished quality. Right. No need to buy off land.
What about North Asia? And we're talking about maybe Japan, China, Hong Kong.
So my favorite is Japan. China, I have yet to go in and explore. Now with Beijing being a little bit tighter than in the past, I also don't know where to start for going into China. I'm afraid of their policies changing to be not so favorable to foreigners. That, like many other countries' regimes, actually, we seem to be not friendly to foreigners buying our residential properties as well. My favorite is Japan. Stamp duties are very low. Stamp duties are staggered from $2 stamp duty to Sing dollar all the way up to 5,000 Sing dollars. That's if you buy a building that is worth maybe 50 to 100 million dollars, you have hit the cap of stamp duties that's at 5,000 Sing dollars. So the investment returns versus the bank lending rate. Banks, if you are going in as an institution buying a building that is 10 to 20 million dollars, you can still get a bank loan that is at about 1 to 1.2% today. So it's developed nation with the lowest interest rates today, lower than US, Europe, and the rest of the developed.
But you just have to be careful about the inheritance taxes.
Yes.
in
So
Japan.
you need to go in with a proper investment structure.
Okay, let's go back to ABSD topic in case we get a bit run away with,
Distracted, yeah.
with the wider region possibilities of buying real estate. Yeah, taxes other than ABSD, very glaringly when we look at the changes, seller stamp duty was not even kind of like on the radar.
Correct. Partly because of the increased normal stamp duty. Now we are rarely at 3% anymore, right? We have gone to 4% if it is above $1 million, and there's 5 and 6%. So when the investor buy in, his total cost is not 100, his total cost is 100 plus his duties and other fees, right? So you might say that he has purchased at $100 and then his cost in total might be 100 plus another $6, so it's 106. So many speculators wait for the property price to go up 15% and then they sell. But now you need to have the property price go up more than 15% because your costs have gone up. And also, although prices have gone up in the last few years, it hasn't gone up by enough for you to really say, hey, within 2 years, I can make 10%, but then my cost is 5 or 6. So if I were to sell now and within 2 years, plus of course there's the seller stamp duty, then I wouldn't sell. So the number of people selling within 3 years has very much reduced. In fact, although I still see some numbers on seller stamp duty, it could be because of poor planning for estate transfer that causes the children to, somebody would have to pay the seller stamp duty.
Because they have to deal with the continuing mortgage that was not paid off on the property. They can't hang on to it, or some potential disputes between the beneficiaries and they don't want to hold on to it anymore. Okay, so seller stamp duty doesn't seem to have been in the radar. Okay, property taxes, and I think the audience, particularly the foreigners, would need to understand that it's calculated on something termed as the annual value, right? So in Singapore, the Inland Revenue will assess every property to have a certain annual value, and that could will be reviewed from year to year depending on the particular district or something.
In the past, it was much easier to estimate because the property tax was just a flat 10% of annual value. And then when we try to estimate what is annual value, we just sample like 10 rental apartments of the similar size in this neighborhood. And then just using that average, we discount by 20%, we apply the 10% mark, we know that property tax is about $1,000 or something like that. Today, not only is the tax staggered and tiered, it has also pushed up to very high tax levels.
Yeah, which we're going to just show everyone in the next slide what it's going to look like. It's gone up 2023 and is even going to go up higher in 2024. And another thing to note is that the property tax will also depend on whether you are an occupier of the property as the owner, or you have a property that is not occupied by you, but it is intended for investment. Or if it's an unoccupied property, then it will be treated at the non-occupier's rate. So let's take a quick look at the rates. It's a bit small for some of you, but we needed to put the two charts together so that you can appreciate that since 2015, you'll see that these are the owner-occupier rates. It was up to 16%. With the changes, you'll see that property tax rates have bumped up to 23% today.
Okay, so that's at the highest level. But let's take a look at the first $100,000, which on the left-hand side chart, on the left-hand side charge, first $100,000 is at the 10 to 12% band. And if your property's annual value is $100,000, your property tax payable at that time was 5,480. Today, you look at the first 100,000, the first 100,000 is at the 18 to 23% band. And the property tax you have to pay is 8,730. So 8,730 divided by 5,480, that's a $3,000 increase on 5,000.
So about
60%.
60% increase.
That's 2023.
Yes, and just to highlight what's going to happen in 2024, the rates are going to bump up to 32%. If you are living in a high-end property, you could expect to pay anything between 26 to 32%.
Yeah. So the first 100,000 here now is 11,980, which is double of the first 100,000 of the year 2021. So a property with annual value of about 100,000, if you could imagine, it's not even a giant group class bungalow or anything. It is a property that probably attracts about $10,000 rental a month. So a 4-room apartment, not even at the Ardmore Park or Nasim area, a 4-room apartment, say in Holland Road area, Bukit Timah Road area, that would be $10,000 a month in today's market, and that would attract from 2024 onwards a $12,000 property tax.
Very, very hefty. And this is just being yourself, an owner of the property, paying this kind of rates, right? And of course, in a condo, you also pay the maintenance, sinking funds, and other dues on the property.
Yeah.
Right.
So this is for own stay and monthly possible rental of 10,000, but annual property tax is 12,000. 12,000 versus 10,000. You can see how that goes. But if you were to rent out your apartment.
Okay, so let's look at the rates for non-occupier, non-owner occupier residential rates. Previously, the top rate was 20%. And that's for the above 90,000. So you pay $12,000. But in 2023, the rates have been bumped up to 27%. And it takes only 60,000 and above for you to hit that rate. And the figure there is 8,850. Right? So work off the math, you find that it's going to be a lot higher in percentage terms. Again, 60% or more.
Yeah.
2024, what's going to happen? The rates are going to be bumped up even higher from 32% to the highest rate, 36%, above $60,000. And you're going to be paying a lot of property tax. So whether you own the property, living there, or if you're going to rent out the property for investment return, you're going to be hit by a very hefty amount of property tax, which just for the audience understanding, these are rates that affect residential properties. For non-residential properties, and where foreigners can also invest in, right? Your commercial shop houses, industrial buildings, the tax rate is 10% of the annual value. So maybe that opens up another arena of potential investments for real estate, but non-residential properties. Okay, I've got an example here in my next slide, and some reminders for everyone here. Property tax is a tax on property ownership and applies whether the property is rented out, owner-occupied, or vacant. Something tells me that in the past, if the property is vacant, you had some credits or exemptions. Has it changed? Right.
In fact, it is.
I mean, a long time ago, if you had a property that was vacant, you probably had some kind of
you can,
allowances or something.
You can claim for some allowances if you prove to IRAS that you have tried to rent it out, but it couldn't be rented out. Then you can ask for some discount on your property rent. So the discount would then be whether it is owner-occupied versus non-owner-occupied. They take that into consideration. But even our aging demographics, when somebody senior passes away and they bequeath the properties to the children, it takes a few months. In fact, sometimes it takes more than a year before the property actually gets sold by the children. In the meantime, it is vacant.
That's right. So during the probate process, well, the executor is still sorting out all the legalities, and the property is left vacant.
Will it be taxed at the non-owner occupier tax rate because the children in Singapore, 90% home ownership, right? The children mainly already have their own properties which they are claiming the owner occupied tax rates on. So they can't say that, oh, the second of my parent has passed away, the house is now vacant. We are still living in it. No, because they have already got another residential property which they are claiming the owner occupied tax rate.
Yeah, you can't tell the IRAS that the deceased owner is still living in the property in spirit. Something. All right. Moving on. So this is an example of a high-end property. So we're talking about maybe foreigners who have invested in good condominiums like Ardmore Park, where you are enjoying perhaps rental of $20,000 per month. Yep. Okay. And estimated annual value, let's say, is about $168,000. Right. So what's the impact? Maybe you want to take us through for that Ardmore Park owner. Right. Some Indonesians obviously may have a home in Singapore in Ardmore Park, and therefore treated as an owner-occupier rate. But look at the rates that have been bumped up.
So for owner-occupier rates, it has more than doubled. For investors who are renting out the unit, it has just under doubled from 27,000 to 49,000.
That's for next year, 2024.
Correct. So I'm comparing before 2023 and after 2024 has started. The first Gen 2015 lasted until December 2022. So then the tax authorities are staggering the increased rates over 2 tax cycles.
Right.
So now you try to calculate your ROI again. You are renting out at 240,000 a year, but from January 2024 onwards, your tax is 49,000, which wipes out 2 months of rent.
Yeah, and then you got to work out the math and find that it's really not so interesting, or it becomes really expensive either to be living in your own home or even renting it out for the high-end market properties. Okay, I need to move on and really talk about this other part of it, about the impact of all these changes. How would it affect the will making and the duty of executors, right? So I always say one thing to an audience. If the will is very simple, for example, it doesn't give any instructions as to how the executor is to deal with a residential property in their estate at the point of death, then the fundamental responsibility for the executor is to liquidate the property and distribute the proceeds to the beneficiary. That's the fundamental. But if you wanted the executor to hold off the sale of the property for a little bit longer, by a couple of years. Why? Because there could be an aged spouse who continues to live in there, or there are young children living in the property. Then there are all these potential issues that will crop up, right? Another thing you need to understand about the stamp duty regime and the planning would be that when it comes to living transfers, that's where all these stamp duties come into the picture, right? Stamp duty is a tax on living transfers, so bear that in mind. And whereas death transfers, there is no impact of stamp duty whatsoever, not even the ordinary buyer stamp duty. Yeah, not yet, but it comes after that when the beneficiaries inherits the fractional interest of the property left by the parent on death. So you could have a family of 3 children where they each receive a 1/3 share of the parent's property. And that's where you are now a 1/3 owner. And that's where, under the rules, even if you own a fractional interest in a residential property, that becomes a 1 count, which means that if you are looking to buy your own residential property, it becomes your second purchase. So second purchase as a Singapore citizen, you end up paying 20% additional buyer's stamp duty.
Or one of the 3 siblings wanted to transfer his shares to the other 2 siblings, and the other 2 siblings already have their own private residential. Then when you transfer the shares to them, each of them would have to pay whether it's his second or his third,
right?
or
Yeah. So very
ABSD.
right? So again, drawing back to the will making, go back to your clients, review the wills. Have they addressed these kind of potential pitfalls by simply saying that when I die, all my assets are to be distributed equally among my beneficiaries? These consequences could be very painful and economically for their children. Testamentary trust will certainly be a very good way of doing estate planning. And in my other training, we always talk about the trust for a life tenant, especially if you want to protect the rights of a certain beneficiary to have the ability to remain in occupation after the death of the primary owner. Talk about a trust for sale, which gives ability for executor to delay the sale of the property until such time when they can exercise their discretion to sell the property, because none of the children require that property for their occupation anymore. And interestingly enough, a trust for sale under the traditional English, the former English law rules, right? When you say that the property is held on a trust for sale, it is not per se a vested interest in the property, but in the proceeds of sale. Very interesting. The United Kingdom law on this doctrine has been superseded by legislation in the UK, but in Singapore, that seems to be the position. Right. Other kinds of possibilities could be the use of a standby trust, which is a discretionary trust. And we found that it could be very useful to have the property that is left behind by the deceased go into a discretionary trust only upon their death by the will. And if you are a beneficiary of that discretionary trust, it does not impact your account. Why? Because in a discretionary trust, the beneficiary does not have vested interest in the trust property. Okay. You want to delve more into that? Is something maybe we can take it a Q&A or in another session of training.
Change the mic.
Okay, and I just wanted to end this slide talking about vested and non-vested interests, because this is how the Inland Revenue, when they determine whether a beneficiary or any person have a vested interest in a property for account on their status, right, would be to examine the document, and depending on how it's drafted, if they can determine that on the face of the document, the beneficiary has a vested interest, then it becomes a one count. Okay. All right, I think talking about other impacts, we could see that maybe unlike a previous generation ago, whereby a couple would generally be buying the matrimonial home, husband and wife together. Maybe because of this regime, it does make sense that you just want to use one name for the purchase and reserve the other spouse's name for yet potentially purchase of a
Correct.
second home.
But then if you are demonstrating love towards each other, your matrimonial home should have two names, right? And then with two names going into the home, you can have increased leverage because both your incomes are taken into consideration by the mortgage lender. But now I wonder what happens if you bought the property in one person's name, but then the other spouse wants to lock up a share and interest of this home in case of divorce. And we have got now some popular thing called the prenuptial agreement. So then what happens? Would IRAS want to consider that, hey, even though it's bought in one person's name, the other person contributed to the home in terms of taking care of it, making good, maintaining it. So there is a beneficiary interest to this other person whose name is not on the property.
Yeah. And if we want to deem that kind of transaction as an anti-avoidance scheme of sorts, right? But certainly another phenomenon is the decoupling that has happened with the introduction of the ABSD regime over the last couple of years.
Yeah, so a couple will go to the law firm and then one person will sell his share to the other person and take some...
To free the name of the second couple because they now have the interest to buy a second property. But these are all going to invite a lot of potential problems, like you say, the legal arrangements, the family arrangements and all that. So I think the lawyers will have a field day when the disputes happen with the couple.
That's why some people went to set up absolute trust.
Yeah.
And then,
absolute trust, as you know, if you use a trust to purchase residential property, now the ABSD rate is 65%. Right? It kind of like make it uneconomical for people who have considered, like, if I'm going to, if I have a young child, could I therefore use the name of the child for the acquisition of the residential property and all that? Well, it's still possible to do if you are prepared to fork out the 65% ABSD and later seek a remission from the IRAS. Right, so it's taking that chance that IRAS will determine that in truth, this is not really
avoidance.
You know, this is an avoidance scheme. So there's the risk there. But I truly believe that if there were genuine motives, for example, if there was a special needs child and the parent wanted to ensure that this special needs child will have a home, it can still be done, right? It's just that the motives must be genuine. And for goodness sake, better appoint independent trustees to do their job as trustees.
And it is very expensive because under this scheme, you cannot take a loan. You have to pay 100% for the property. Then you pay the normal buyer stamp duty. Then you pay the 65%. Then you try to claim back that 65%, all cash.
But possible with genuine motives, or may not need to be a special needs child, but it could be a a person who is vulnerable and you want that trust to hold that property. Right? So for existing owners, I think from what we have shown in this short 1 hour, that really succession planning is something that comes center stage, particularly with your clients own multiple properties. And for foreigners, it becomes more pronounced, especially if foreigners may not realize that assuming if the foreigner left his property in Ardmore Park to 2 of his foreign children, and one of the foreign children decides to cash out and tells a sibling, take the property for yourself. In that transfer, it's going to be very, very punitive because you don't look at fractional interest anymore. You have to pay 65% ABSD on that transfer. Whereas for the Singaporean citizen, it depends on whether the person acquiring owns any other residential property. For foreigners, no discount. You end up paying the full brunt of the 65% merely by one sibling transferring the share to his foreign sibling.
So back to the point where financial advisors might want to go back to review some of the wills that they have done for the clients in the last few years. Also review with the clients and their families whether there's any changes to their citizenships, because it could have been the plan 5 years ago that they also wanted the children to become Singaporeans or PRs, but within the last 5 years, the child may have decided to take on Aussie citizenship or somewhere else, and also high tax regimes.
For landed properties, certainly there are, even for Singaporeans, the children are no longer Singapore citizens, so they cannot simply pass on the property to their foreign children who have become citizens elsewhere in the world, right? One other observation is like, perhaps, for many, I didn't realize there were so many in our Singapore demographics. Right? Already the statistics show that 1 in 5 persons in Singapore is, the origin is not from Singapore, someone who was born in Singapore.
Yes.
And take this demographic group of, let's say, the Indonesians. There are something more than 300,000 Indonesians, people from Indonesian descent who are living in Singapore, who are now either PRs or citizens.
Yeah.
Right, so you look at an Indonesian family whereby they have both Indonesian children who remain as such, and I press on something. Okay. All right, Indonesian families with both Indonesian children and Singaporean children or Singapore PR children.
Yes.
So
mixed family
will have to be factored into how you structure the inheritance. Yep. Okay. Okay. I think our time is coming up.
Yeah, just a short.
All right. Okay. All right.
We can continue after there's a part 2.
Okay.
Okay.
We'll break here.
Let's have a slide. Last slide.
Yeah. So.
Okay, this is where we left off. I think it'd be useful for us to understand the differences between leasehold and freehold today in the current regime. What's your takeaway on this, Yong?
Generally, leasehold private properties in the long term should trade about 20% below a freehold, but because Singapore is small, there's not enough data points for us to do this type of tracking. Plus, real estate doesn't have sufficient similarities between one apartment in this condo versus the other apartment in the next condo. So it's very difficult to draw a line to say leasehold versus freehold, which one should be valued by how much premium or less. But in one study I did, I just compared South Haven 1 and South Haven 2 in Upper Bukit Timah. Same developer, side by side, 2 properties, and one of them is freehold, one of them is leasehold. And then you track their price difference over the years, and it turns out to be about 15% price difference. Today, you would see that the proportion of leaseholds has gone up a lot because every government land sale for developers to build new properties would be leasehold. And in fact, the leaseholds, with the exception of maybe in Orchard Road, Nasim, Claymore area, the leaseholds valuation could easily exceed freehold valuations, let's say in Ang Mo Kio. Recent new launches in Pasir Ris, Ang Mo Kio, Tampines, all have gone to the, in fact, in Ang Mo Kio, Lentor has gone up to the $2,000 per square foot mark, right? And so these are higher in value than the freehold valuation. So difficult to compare 2 properties together, but what we wanted to highlight to people who are doing their wealth transfer planning about this point on leasehold and freehold is, while you're writing your will and you are still planning that you have got another possibly 10 to 15 years of life to go, you should be cognizant that at the point of time when you pass on, your beneficiaries may not be as well educated as you about property investments. Your children and grandchildren could all be professionals doing their own thing, AI, data engineer, doctor, vet, and they are too busy to understand what is an investment property. You bequeath them the properties, they are holding on to something that is depreciating by the day. If the leasehold property has expired, say 40 years, left with 59 years, it is difficult to resell in the open market because the next buyer would have some CPF and loan restrictions. So there are fewer buyers in the market for such old properties. And they will have to take out more cash to buy, and therefore they will offer a lower price. So do you really want to bequeath such properties and have them in your will for somebody who is not so familiar, your loved ones, to handle and then to sell and possibly sell at not a very good price in 15 years' time anyway?
So the triggers for leasehold properties would be pressing when, let's say, 30-something over years have lapsed, and one generally will look to exit through en bloc because each of the strata owners will face the same predicament. But interestingly enough, if you have a leasehold condominium where you have Singaporean owners as well as foreign owners, would the foreign owners therefore demand a higher price, given that if they were to go and buy another property after taking the proceeds, they have to pay ABSD of 65%.
So they may not willingly participate in the en bloc sale,
right,
because having sold it en bloc, they would find it very expensive to find a replacement property for themselves. So a few examples you can think of might be famous condominium called Mandarin Gardens. It's 30 over years old, right? It is in that sort of a predicament now. And Mandarin Gardens also has quite many foreigners. Yeah, the whole stretch of, in fact, Amber Road, many Indonesians used to like buying that location.
Right. Okay, what about multi-million landed properties, those detached properties where maybe they bought the property, 15,000 square feet 20 years ago, and they were only paying maybe like 4 million.
Yeah.
And today that property has gone up to like 20 million.
At least.
Right. And they have like 3 children. It's such an illiquid asset. Imagine transferring a 1/3 share of a multi-million-dollar property to each of your 3 children. They work in their heads. 20 million, if we sell it, we all pocket 6 million plus.
Yes. And then there's the operationalization of that transfer. If you wanted to be fair to all three of them, you would ask all three of them to be executors, and then all three of them want to appoint their own favorite agent. What if between the three of them and their spouses, there is some disagreement? And that's all these mechanics. So sometimes it is not that you should be fair just by giving everybody equal share, equal responsibility. You might want to, in fact, appoint one person to be the executor for this property, so that that person controls the sale of the property by this person appointing the agent, the other two having just on certain terms to agree with this person who is doing the work.
Right.
Yeah.
I think because of these high capital values of these landed properties, it's also very difficult for a beneficiary to make an offer to his sibling and say, I take it off your hands for X dollars. In the past, possibly, but now it gets a lot harder.
Because of the additional buyer stamp duty
That could also
so
be an
expensive.
impact, yeah. But it's also because of the high capital values that are involved today than, you know, a generation ago, right? Subdivision. So if these huge detached property has a nice wide frontage, and maybe it is like 30,000 square feet, the possibilities could be that the owner says that, well, if you can't take the share of the property for yourselves on this one property, one way is to tear down the building and subdivide it if it's possible. That's something.
A lot of terms behind that, yeah. So the frontage for landed property, plus access road, plus there has to be enough electricity to supply two houses and all that. A lot more considerations from NEA, PUB as well.
Right. If it can't be achieved, then it probably looks as though sale seems to be the only possibility.
Yes,
really.
sell it to a developer who has got the expertise to take care of all these headaches.
Concept of dual key ownership.
Yes.
How popular is it? Maybe you want to explain how it works in Singapore?
So dual key apartment units, one apartment with one single address, but with two front doors. So the two front doors, one would usually lead to a studio unit, the other front door would lead to a 3-bedroom unit. So in that case, a big multi-generational family can always use it as, for the grandparents, they stay in the studio unit, they can get in and out as they like, it's their own key. For the rest of the family with the kids, they are in the 3-bedroom apartment. But it is one address, one strata title, which means that the person who bought it actually has two keys, but he didn't need to pay ABSD. So when ABSD was introduced 12 years ago, it was a popular thing for developers to introduce these dual key units, because for Singaporeans at that time, buying the second property, still there wasn't ABSD. So they bought a second property which has got these two keys. So they are in fact able to rent out two separate units. But in the past 2 to 3 years, I don't see that many dual key ownership units anymore, because whatever was launched 10 years ago, they were completed, let's say, in the years 2016, 17. And when people start to lease out these dual key units, sometimes they lease out both the dual key units. And then you have got to have an additional PUB meter. When you are subscribing to StarHub, there's only one address. StarHub recognizes one address. And then when your other type of subscription, you have only got one mailbox, so the letters and all that all get mixed. So you need to have two sets of tenants if you're renting out both keys, both units. They have to be very friendly with each other, to cooperate with each other. Meter readings, subscriptions, letters getting mixed up in the mailboxes and all that. So I think on the tenant management side, it has been a little bit troublesome. Might not be worth the trouble.
Okay. And then, yeah. Well, the final point there is that if if you're looking at very wealthy clients with huge portfolio of real estate or residential properties, remember what I said earlier? The transmission of property on death into a trust or into a company, or in fact, the gifting on death would not attract any form of stamp duties whatsoever. So you could look at the possibility of structuring the inheritance into a trust or into a family holding company of sort, right? But for today, we can't comment too much on that. You'll take another session for that. And then finally, we need to just put things in perspective that in any form of planning, structuring, we need to be mindful that the structuring will not be deemed as a scheme to avoid tax. And in this instance that we want to highlight is something called the 99-to-1 loophole to avoid ABSD. Maybe for our wider audience from elsewhere in the world, you want to quickly explain what is this 99-to-1 loophole.
So a rich person who has already got several properties, he doesn't want to pay the additional buyer stamp duty on owning a new residential unit. He could get, say, his son or his daughter to buy the property first and becomes the 100% shareholder owner of that property. But then because the son or daughter may be young, say 24, 25 years old, still in university, no income, he has got no borrowing capacity. So he might be able to own it at 100%, but he can't borrow 60 or 70% from the bank because he has no income. So that's where the parent would have to add their name to the property. So after he has bought the property, he sells 1% share to the parent, who then pays ABSD on his 1% share. And his ABSD might be the 25, 30%. He just pays 1% share ABSD. 99% is owned by the child, and then together they become joint borrowers against the property, and then based on the income of the wealthy parent, the banks would be able to lend the money. Now, there are actually several issues. The fact that the bank is considering even the 1% shareholder to be fully liable for the loan, despite the fact that he only has got interest in 1% of the property. That one, I'm unsure how it might play out when court cases happen, or when there are, let's say, divorces and people challenging your ownership when these cases happen. But this is one way that some families have tried to reduce their ABSD payment by using this scheme of you buy first and immediately after the sale and purchase is completed, you sell 1% to the parent.
So this is now no-go. And if you know of any transaction of this nature, you could be a whistleblower and you can get a reward from the IRAS. They will pay you.
If you get a reward from IRAS, imagine getting money from the tax authorities, you know. The other way around.
Exactly. Okay. So, yeah, that's what we wanted to cover for our session. And before we go on to the Q&A, Lisa has something to announce.
Thank you, Mr. Lee and Mr. Koh, for a wonderful sharing. So
there are quite a few questions, so we need to be selective. So I apologize if we may not be able to answer specifically to your query. But there are quite a few general questions, which will be, the first couple will be for Yong. They are really looking at trends, like the first one. Most of launches are purchased by majority of Singaporeans. Would you say that they have long holding power based on the current interest rates? Another one is, what are the thoughts of Singaporeans paying high prices for resale HDB as compared to buying a private property? Next question, will landlord pass on the increase in property taxes to tenants?
Okay, let's take the third question first. Will landlords pass on the increase in property tax to tenants? Landlords wish to pass on all cost increases, and recently the cost increase of being a landlord is not merely the property tax that they have got to pay. Inflation has also pushed up maintenance fees. The minimum wage sort of guideline for security companies means that if you own a condominium unit, your condo MCST is also charging you higher fees because the security companies are paying higher salaries to the security guards. In addition, inflation is also pushing contractors and the material suppliers, parts suppliers to charge more for property management services. So as a landlord now, your cost increase have gone up. So it's not just interest rates that are pushing costs up, it is inflation and the MCST bills, plus it is property tax if it is residential property. So landlords will try to keep their asking rentals high. However, the last 2 months, we've already seen quite a significant slowdown in terms of the requests from tenants for moving and for new tenants that are coming in. Partly, I mean, you guys are in the financial markets, you would know that, for example, there's only one main Swiss bank now, right? The other Swiss bank that has been absorbed, they were employing, I don't know, 2,500, 3,000 people in Singapore. I don't know how many of them have been retrenched. So there has been retrenchments in the last 12 months already. The venture cap and the technology financing and capital markets in the technology segment has also weakened somewhat. And so you don't hear of so many new technology IPOs these days. And because there's very few IPOs, it goes further upstream into the venture capitalists and the angel investment segment as well. So the tech startups are also not hiring as many. And you would also have heard then people like Amazon, Facebook, and all that are retrenching, and Singapore is a home to many of these high-tech companies. So last 2 months in particular, I've seen that some of the landlords that me and my colleagues are representing, that the number of phone calls, instead of, let's say, 5 calls a day, we may be getting 15 calls a week type of, in terms of the demand. So it has slowed down quite a bit, but of course it is still hotter than pre-COVID, because 2017, 2018, those were really weak times for rental.
So the general trends is that things are just continuing to be more expensive.
They will,
no choice.
Landlords will try to pass the cost down, but then landlords are also competing with the next landlord. So what we have to watch out for is whether there are more vacant units coming up. Then maybe rentals would go down despite the fact that landlords need to recover more costs. Then question 1 about majority of locals buying condominium units and then taking loans, do they have long holding power? We have got to, unfortunately, we don't have the data, but we need to split it down to, are these young families who are starting off in their career, and if their career, one of the couple has a stumble in the career, say a retrenchment or a downgrading, will they be able to maintain that home mortgage payment? Otherwise, if you look at the macro data for across Singapore, your home valuation, yours and my homes all added up together, yours and my loan all added up together, we are only at a national loan to value ratio of less than 40%. Because at a national level, if our loan to value ratio is only 40%, there's nothing for the policymakers to be worried about, because some of us are living in fully paid homes. Some of us are geared up to 70, some of us are geared up to 80%, but there are many of us who are also living in fully paid up homes. So overall, the loan repayment capability on the macro scale doesn't seem to be a worry for the government. What are your thoughts on Singaporeans paying high prices for resale HDB? financially, is it a wise decision? So I will be running more seminars, I think one more next week, Saturday, about the lease buyback scheme from HDB. But when I speak with my university students, some of them upon graduation, they are already teached and they went to apply for BTO. I would tell them to plan carefully and plan for what they need to do when, for example, there may be a retrenchment. Your retrenchment could come when your second baby is just being born, additional expenses at the same time as having lesser income. Plus, you have to plan for what happens when you're 65 years old. Today, you buy an expensive HDB, say $800,000, you borrow 500,000 on the 800,000. Your 500,000, if you took a bank loan, not the HDB loan, you are paying 3.5%. Then you are using your CPF to pay that 3.5%. By the time you reach 65 years old, you look back, you realize that too much of your CPF money has gone into the property, not enough has been accumulating and earning interest.
Yeah. One point about if you are going to allow your beneficiaries to have access to the HDB market or BTO as the first purchasers, then make sure that you don't ruin it by letting them own an inherited property.
Or setting something up in the trust for them.
Right.
Yeah.
Okay, I'll just quickly take Alfred's question. Is it possible to get remissions of the 65% tax for property trust? The answer is yes. You need to convince the IRAS that you have structured something for the absolute benefit of the identified beneficiary and that it is a genuine trust for succession and inheritance purposes, right? Or for protection of the vulnerability of that person. Right, let's move along. And other questions, perhaps I'll take this one from Wu Hao. If the children already have their first property after I die, this is the last one on the slide, maybe you want to scroll it up. I give my property to my children, each 50% share of the property. Will they need to pay additional stamp duty when they inherit the property? No, the answer is no. Any property that is inherited will not have your beneficiary needing to pay any form of stamp duty whatsoever. From Agnes, can my children sell my property and not be taxed if I die, if they have their own property already? Well, if the children inherit the property, whether it's a second or a third in their account, selling it is not a problem, except be aware of seller's stamp duty. That is the period of holding of the property from the initial acquisition by the parent. If it has crossed a 3-year time frame, then you wouldn't have the seller's stamp duty in play.
Okay, so just to be clear, if I bought a property today, willed it to my children, but then next year, this time I passed away, and then my children, instead of inheriting it, they decided to sell it. So their inheritance would not attract any duties. So they can own my property. But when they sell it, from the day I sign and exercise my option to purchase until when the point they sell it and the other buyer signs on the SMP, exercises the right on the option to purchase, that period may be only 1.5 years. And therefore, there is a seller's stamp duty applicable. And the seller's stamp duty is on the total value of the home. It is not on the profit, which is, there may not be a profit, they may not pay anything. But then if it is, I paid $1 million, they urgently sold it at $900,000 within 1.5 years, they have to pay 8% on the $900,000. So it is a double loss for the family.
I'll take the next question from Fred. I have a client with multiple properties and 3 kids. She was thinking to reduce the hassle to just liquidate all her assets upon their death and simply distribute the cash proceeds. What are your thoughts on this? I think it will be too simplistic a planning, because if you liquidate everything, well, and you give all the cash away to the children, they're probably going to squander it, or some will squander it, all of it too quickly. You know, a person's portfolio of assets will comprise of the cash, properties, and other forms of investment. So it's really having that discussion with the financial advisor as to what makes sense, right? With real estate, there's certainly a propensity for long-term capital gains, right? But you just have to navigate and make sure that you don't end up with the ABSD problem. So you have multiple properties, I'm not sure how many, but you could definitely decide to give property to each of the 3 children. So they take a property outright for themselves, and they can live in there, they can decide to occupy it or even sell it one day. And you have surplus properties, then you may want to consider a structure like what I mentioned. You could will the properties and pour it over into a standby trust, whereby the properties can continue to receive rental income. And yet another possibility is to perhaps will the surplus properties into a company structure, a company holding. You don't have a problem with the stamp duties on properties passing to the company. And as a company, it can therefore continue to earn rental income. Yeah. And then you can always structure it together with a trust as well. So that's planning for another
These are
day.
the types of case studies that we discussed in the 2-day course, where Chiwi goes into details of how the private trust company may be set up. You would then need a board of directors and stuff.
Okay, question from
There's a question here.
Chong He. Okay, I'll take this one first. Do you have any experience of individuals owning a multi-million landed property held in an investment holding company to save on stamp duties back then, and is facing the issue of paying non-owner occupied tax rate now? Are there any ways to unwind these arrangements for them? They currently own many properties, and putting the landed property back to the personal name would incur a ABSD. Yes, that is correct. So the last transaction there may not be meaningful. But if you really have a property held in an investment holding company, it's true, you end up having to pay the investment property tax rates. To try to reverse it back, it's just not going to be economical. And I'm not sure whether the savings of for very high-end properties, whether it's that significant. As an owner-occupier or property being rented out for investment, is all very high anyway.
It's all very high.
Yeah,
it is significantly higher.
Okay.
But then
to reverse,
IRAS has closed the loophole over the last 5-6 years by introducing this thing called the ACD.
That's correct.
Yeah, which is also something we will discuss in detail in the course. So the investment holding company is now classified as a ACD. What does the ACD stand?
Advanced Conveyance Duty. Advanced Conveyancing.
It is a company that owns a share of a residential property. And so when they transfer the interest in that residential property, there is an advanced conveyancing duty that has to be paid, and it is at the same rate as the ABSD for entities, the top rate.
Yeah. So for that to be deemed as a property holding company, 50% or more of the balance sheet of that company is held in real estate, residential property.
Yeah.
Yep. Okay. Next question. If husband and wife are staying in HDB, husband has an investment private property and had willed the spouse to take over the property when he is not around. In such case, can wife hold on to HDB and private property at the same time? Yes, if you really own the HDB and the private property, and the inheritance can happen. Bernard Fang, my client has a 99-1 on a GCB, the loophole thing. What can we do to help her fix it now? I think, Bernard, you Be a whistleblower for one. Well,
Taking any action now would just highlight to the authorities that, hey, I'm here.
sometimes you can voluntarily step forward to the IRS and say that, yes, we did this avoidance scheme, so can we pay, a negotiated amount of tax?
Yeah, without paying penalty, meaning just pay the tax that you would have paid.
Because I voluntarily came forward. I didn't realize that I couldn't do this. It was my lawyer who schemed this up. And I went along with it not realizing. So maybe we can negotiate a payment. Okay. From Winnie, what about taxing vacant properties to try to bring down rentals? Not clear on the question.
Yeah, there's a vacant units can be taxed much higher property tax rates. Then that will force owners not to leave their properties vacant.
All right, okay, right.
It's
So
of course
essentially,
possible. Yes.
better to rent out and get something rather than leave it vacant and still having to pay property taxes. Also from Winnie, I have a client who has a company holding a residential property as an ancestral home. She wanted this property to be held as ancestral home after her death. What must be done now or what trust structure must also be set up to ensure that the residential property is held as an ancestral home? Landed properties will have their own issues as well, because you have to grapple with the provisions of the Residential Property Act. So you need to prove that all beneficiaries are not foreign, or they have to be Singapore citizens, not even PR. Well, I can only imagine that the landed property be willed into a trust, right? Property can also be willed into a company, and the company is held in trust. What you need to convince the land dealings unit is that all beneficiaries, all directors of the Singapore company, if it's part of the structure, are all Singapore citizens.
The property is already under a company.
So it's already
We
under a
should
company.
just entrust the company into a trust.
Yeah, then the shares of the company could be willed into the trust, which I mean, the land dealings unit will want to be convinced that there are no foreign elements. Okay, something we can explore. Okay, someone here with a question.
Hi, I wanted to ask about the count of property ownership, because typically that would be from the date of the contract. But in terms of inherited properties, when does the beneficiary acquire the property? Would it be from the date of actual transfer by the executors or the administrators to the beneficiaries? In which case, could the executors just either A, not apply for grant of probate, or B, transfer the property under a transmission application to the executors or administrators' name, so that the property is not transferred to the beneficiaries? So I'm not sure whether IRAS has mentioned specifically. I'm looking at the website right now, and officially it says properties acquired or transferred, sounds like past tense, by way of gift, inheritance, are to be included in the property count. So you could simply not transfer it as yet. No doubt, as you brought out, you have to deal with the higher property tax, but this could be a solution because sometimes a testator could have passed on, someone could have passed on, and the beneficiaries, one are young and starting out, they want to buy their own property, or in certain scenarios, they need to buy the HDB. I am not too sure what HDB would see in terms of their ownership of private property. So could I have your thoughts, please?
Yeah, I guess one would have to look at the instrument, essentially the will. Would the will have left vested interests immediate vested interest in the beneficiary. And therefore, if so, then the vesting beneficially would have occurred at the point of death of the deceased. So I think IRAS will look at the instrument to study it and see whether vested interests have been created. There is a possibility that if there was no vesting, but a future vesting, then based on the document that they interpreted, then the beneficiary would not yet have a count. So it's quite tricky, and I would suggest that for some of these scenarios, it is probably best to write into the IRAS to ask for some kind of a ruling. There's a process that's possible with that.
But if you are still working on writing the will for the client, what flexibility should you include as a term in there so that maybe one child is planning to get the BTO?
Yep.
So you allow them to have the decision to sell it instead of actually transferring to their own ownership. That's is a matter of crafting the writing in the will, right?
The possibility of selling is perhaps always there, assuming you have a vested interest and you could get your executor to convey the property to you immediately. That option to sell is always there, so you then don't have a count, right? So we've talked about vested interest that potentially could be immediate vested interest that occurs upon the death of the deceased, or it could be a future interest that vests in the beneficiary, that property only vests in the future, right? In which case, it then be potentially regarded as a form of non-vesting. And if it's not vested, because there could be some conditions precedent to be satisfied. For example, it requires the beneficiary to survive to a certain age, 30 years old, and he's not yet 30. So in that sense, that vested interest is a contingent kind of vesting only. He must survive to 30. So a beneficiary in that situation could say that, could tell IRAS, I've got no count until I survive to 30 years old. That's when the vesting takes place. So I hope that helps.
So at 28 years old, he owns HDB. Then at 30 years old, the vesting happens.
That's fine.
Then he might be infringing on HDB's rules.
You know, expand on that. I mean, it's something that you can't predict, or you know, it's
because it is a known thing, and then HDB might say that, well, you knew that you were going to inherit this, but at 28 years old, you are still owner of HDB. So at 30 years old, now it's in your name. By right, HDB owners shouldn't be going out to buy private property.
That can be really harsh.
So you have
in a
to
sense, I
appeal.
mean, no one can predict the time.
Yeah.
You could die at 29 for whatever reason. Right?
Okay.
So it'll be a bit harsh. I'm not sure, but that's how things are. Right. So really, the instrument that is drafted that have to be looked at by the IRAS when the time comes to have that interpretation. Right. Okay. I'm not sure if there are any final questions. What if the will gives discretion to beneficiaries whether to sell or retain beneficiary interest? Would beneficiary redeem the vested interest in the estate's property in ABSD count? What if the will gives discretion to beneficiaries whether to sell or retain beneficiary interest? Okay, it's not so clear with this question, but it's a possibility that before the vesting, a beneficiary could also disclaim his right to any property that is potentially to inherit. Right? So if he was fortunate enough, he could say that, well, I'll give up my share of the private property that my father wants to give to all of us equally, because I don't want to pay 20% ABSD. Okay. Right. Last question there. In the case where there is a future vesting, does that mean that the executor would be the trustee until such time the beneficiary actually inherit the property? Yes. The moment you take on legal title, it becomes a clear count. When you are only having a beneficial interest, you have no legal title, so you have to look at the instrument to see whether you have the beneficial vested interest or non-vested beneficial interest, right?
So during that time, the legal title sits with who?
Yeah, so somebody continues to hold title, which would be the executor and trustee who is empowered,
Okay.
authorized to deal with the estate of the deceased.
So when the MCSD calls for more money for maintenance, or when they want to do an en bloc, the executor
They
and
direct
trustee
it to
would
the
have to make
executor.
a decision.
That's right, yeah. Okay, time is running, it's already 4. So I would just like to thank everyone for attending this live seminar come webinar today. And I hope I would like to thank Yong too for giving his insights into the property trends. And these takeaways could be very useful for you in your future discussions with your clients who have all these concerns about what they should do with their residential properties, right? So thank you so much.
Thank you all.
Right.